Have you noticed something strange? South Korea's chip exports have been booming this year. AI memory demand has exploded, and the stock market has rallied so hard that global fund managers started getting nervous. But the won? It did not strengthen. Instead, it became one of Asia's weakest currencies. A country is earning dollars, yet its own currency keeps getting beaten down by the dollar. Is there a hidden hand behind this? I am not calling it a conspiracy theory, but if you map the money flows, almost every line eventually leads back to the United States. Follow me, and we will keep watching the market together, not chasing emotion, but breaking down the logic. Don't forget to like, share, and bookmark. A friend of mine works at a Korean company, and I've always thought he was earning a pretty decent income. To my surprise, he recently called me to borrow money, saying it was to pay his property tax. That was quite unusual. While his salary isn't considered part of the high-income group, it's definitely not low. At first, I assumed something unexpected had happened in his life. But after asking more carefully, I discovered that the reason was actually the depreciation of the Korean won. According to my friend, at the end of last year, 10 million Korean won could still be exchanged for 7,000 US dollars. By this month, however, it could only be exchanged for 6,400 US dollars. His income had effectively lost a full $600 out of thin air, which left him deeply upset. After all, he hadn't done anything wrong. What happened to my friend made me take another look at the sharp decline of the Korean won over the past 6 months, and the conclusion I reached sent a chill down my spine. Here's the conclusion first. On the surface, the won's collapse is about Korean inflation, oil prices, foreign outflows, and speculative trading. But the deeper culprit is the dollar. More precisely, it is the combination of high U.S. interest rates, U.S.-driven geopolitical risk, the American AI capital cycle, and the liquidity pull of U.S. financial markets. Together, they have pushed the won into a corner. Around June 17, USD KRW was still trading near the 1,500 level. Earlier in June, it touched 1,549.36 intraday, the weakest level since 2009. And what was 2009? The aftermath of the global financial crisis. So this is not just ordinary won weakness. The market has started pricing the won with a crisis-style lens. The irony is that Korea's economy is not collapsing. Exports surged in May, semiconductor exports jumped massively, and the world is fighting for AI servers, HBM, and memory chips. Under normal logic, strong exports, a large trade surplus, and more dollar inflows should support the won. But reality is the opposite. The more Korea earns, the weaker the won looks. That is the most interesting and almost suspicious part of this story. Why? First, Korean companies earn dollars, but those dollars do not necessarily come home. Export giants like Samsung and SK Hynix can keep dollar earnings offshore, use them for overseas investment, repay dollar debt, or wait for a better exchange rate before converting them into won. So, on paper, Korea has a surplus. But in the FX market, the won does not receive the same level of support. The dollars are earned, but the won does not fully benefit. The second reason is even more counterintuitive. Korea's stock market became too strong, and that actually hurt the won. Foreign buying of Korean stocks should normally support the currency. But Korean tech stocks rallied so aggressively this year that some global funds had to sell shares to control their exposure to one market or a few concentrated names. After selling, they converted proceeds back into dollars. That process creates selling pressure on the won. The third reason is U.S. interest rates. The Federal Reserve's benchmark rate is still in the 3.5% to 3.75% range, while U.S. CPI reached 4.2% in May. Markets were once waiting for rate cuts, but now they are debating whether the next move could even be a hike. Think about it. If dollar assets still offer high yields and U.S. Treasuries remain the deepest market in the world, why would global capital take extra risk in won? This is not emotion. This is the instinct of money. The fourth reason is oil and the Middle East. Korea imports energy, and much of that oil and gas is paid for in dollars. When Middle East tensions rise, oil prices rise, Korea's import bill rises, and inflation rises. Korea's CPI increased 3.1% year over year in May, the highest in 26 months, with gasoline and diesel prices rising sharply. So when the US and Iran move even slightly, Korean households can feel it through fuel, food, and electricity bills. It sounds far away, but the bill arrives very close to home. So when I say the United States is the biggest culprit, I do not mean that America is sitting in a room deliberately designing a won collapse. The scarier part is that it does not need to. The dollar system does the work automatically. US. Rates are high, so capital returns to dollars. Middle East risk rises, and oil is priced in dollars. AI orders grow, and the revenue is still in dollars. Markets panic, and the safe haven is still the dollar. See, this is not a conspiracy. It is something more powerful, the rules of the system. This is where it is worth following us, because the one is not an isolated story. If the one cracks first, the next pressure test could involve the yen, the Taiwan dollar, Southeast Asian currencies, and even broader Asian assets. We will keep tracking three signals: whether USD, KRW can fall back below 1,500, whether the 1-0-year Treasury yield can move below 4.4%, and whether oil can stabilize near $80. If these three lines do not change, it will be hard for the one to truly breathe. Can the Bank of Korea save the one? Yes, but the cost is high. The policy rate is 2.5%. At the May meeting, the central bank did not hike, but it clearly signaled that tightening could come later, and some board members even supported an immediate hike. The problem is that rate hikes can support the currency, but they can also pressure stocks, housing, and household debt. Korea does have tools. The problem is that every tool has thorns. The bigger problem is that Korea is trapped between $2 games. On one side, Korea earns money from AI chips, and the biggest source of AI demand is tied to the United States. On the other side, high US interest rates pull global capital back into dollar assets. In other words, America is both the buyer behind Korea's export boom and the source of pressure on the won. It gives Korea the orders, while taking away the pricing power of Korea's currency. That is why this story feels almost conspiratorial. On the surface, Korea looks strong. Strong exports, strong technology, strong companies. But the real forces deciding the won's fate are not only in Seoul. They are in Washington, at the Federal Reserve, in US. Treasury yields, in the dollar settlement system, in Middle East oil prices, and inside the rebalancing models of global funds. So, here is the practical view. Can the won rebound in the short term? Yes. If Middle East tensions cool, oil prices fall, the Fed sounds less hawkish, and the Bank of Korea becomes more forceful, USD, KRW could move from the 1,500 area toward the 1,400 handle. But that would be a rebound, not necessarily a full reversal. A real reversal requires three things at the same time: lower US rates, export dollars coming back into Korea, and foreign investors returning as net buyers of Korean assets. So today's core question is not simply, why is the won falling? The deeper question is this: how can a country win industrially, but still lose monetarily? That is the frightening part of the dollar system. It does not need to stop you from making money. It only needs to make sure that the money you make eventually circles back to the dollar. Follow us, because I will keep updating this one story. The won is not just a small currency story. It may be an early warning signal for Asian risk assets. If USD KRW moves back toward 1,550, the pressure is not over. If it breaks below 1,500 and moves toward 1,450, that would suggest the dollar's grip is starting to loosen. The market will not give you the answer in advance, but exchange rates often reveal the first crack.
Follow me, and we will keep watching the market together. Not chasing emotion, but breaking down the logic.